Access Kenya today reported their first half earnings, which increased to 251 million shillings from 163.4 million shillings a year earlier on. Kris Senanu is the Managing Director of Access Kenya. He joins us from our studios in Nairobi. Kris Senanu, thank you very much for coming through. Experts say a fair result, but some concerns because first half pre-tax profits declined 55%. Nonetheless, your outlook is positive. Why is that?
Well, basically, our outlook is positive because we're through with most of the infrastructure rollout. You'll be seeing much less expenditure on capex items. I believe the market now understands that we had to roll out our local loop fiber network in order to be able to take gains and efficiently use the undersea fiber optic, which is now coming to Kenya. Secondly, you will be able to see that our costs have held very steady. We've been able to put a hold on that. We are focusing our IT business on recurring revenue as opposed to high-end hardware sales and software sales, which were not making us a lot of profitability. And more importantly, the growth of the market in Kenya has also affected us positively because more people are connecting to us, more people need the internet, and more people are buying more capacity.
All right, let's chip away at it in small blocks, shall we? Your earnings per share fell by 15 cents, which is better than last year when it was 37 cents. So share value is a little better this time round. Tell us what's led to better value for the shareholder.
I believe we're going to see much more profitability to the bottom line based on the fact that our expenses are going down. The analysts have been able to look at the share much more critically now and notice that we're going to be making better earnings because the profitability moving forward is going to be positive.
Right. Now, in terms of some of the declines that we referred to earlier on, experts are saying to blame is the restructuring of the IT business. What are you doing to fix this?
Well, actually, what we've done is what is showing. We did expect our turnover to go down because last year, same time, we had over 240 million shillings worth of turnover, top line growth coming from IT. But that was not very profitable. So what you see today of 70 million is actually the restructuring of that business to deal with recurring revenue as opposed to hardware sales and software sales, which were much less profitable. So what you're seeing is actually what we expected.
All right. Now, we know that earnings in the internet division have remained fairly stable or similar to what they were in 2009. And that's despite all the efforts being taken at price cuts. Now, it's an interesting phenomenon because in Kenya, we know that the level and the degree of mobile phone penetration is much, much higher than internet penetration. So the question is, with all these innovations around prices, what are you doing to make your business more dynamic and make sure that it pays off?
Well, in order to deliver similar top line and profitability from internet for 2010, we've actually had to obviously grow much more aggressively and vigorously. Because if you assume that 80% of our price has gone down by 80%, then obviously we've had to sell much more to many more clients in order to get the same kind of top line and bottom line growth. So we are actually growing positively on the internet side. The market for data is not going to be flying as fast as the one for mobile because you have to remember that data devices are much more expensive for people to procure. And data is more of a need to use basis than mobile, which obviously everybody has. But a lot of innovation on the product side has happened, and with the reliability which the new fiber technology gives us, you will see that changing in the next half year.
All right, you spoke about CAPEX being a real Achilles heel this time around, and that's what the figures reflect, but also talking about the move into data services. Connectivity is a real issue, and I know that by June you were quite sure that your system was 99% foolproof. But in order to get to that particular position and in order to ensure that your data services are reliable, there's been this switch from a satellite link to an undersea fiber optic cable. Now, for consumers, the hope was that moving into undersea cables would result in cheaper prices. You've done that, but also in terms of connectivity, you say that there are improvements, but why hasn't it made a significant impact on your dynamic?
Well, the last bit of the redundancy on international fiber and local fiber was put in around the end of the second quarter, which is when we became 99% foolproof in terms of ensuring our reliability. So those innovations or those technological advances are going to be seen moving forward around the Q4 of this year and Q1 of next year. That's when you're going to see the impact of making sure that our system is now foolproof.
All right, and finally, let's talk about your growth strategy for the remainder of 2010 entering into 2011. You've spoken about the need for a smart rollout of the network in areas outside of the main cities of Kenya. You're talking about greater customer demand. What does that entail?
Basically, what that entails is that we're through with our phase one of our metropolitan fiber rollout. So moving forward, we're not going to be rolling fiber out to just any areas. We've traditionally grown by leaps and bounds based on consumer demand. So the rollout phase two of our fiber will be based on where we see the demand coming from. And what that means is that you will see less capex expenditure, like I said much earlier. And so you will see immediate gains to fiber rollout as we move forward.